Now we are on our chapter number 6. Let's do the same section, financing and dividend decision. Chapter number 6 looks at debt finance. Our debt finance, we're looking at loan or funds to the business without conferring ownership. Right. So here we're getting finance, but we don't have to give up ownership. Right. Unlike in chapter number 5, we're getting finance, but then we had to give up ownership. Right. Now the key features of debt financing arise from an arm's length transaction, where interest is paid out of pre-tax profits as an expense. It means that interest is going to be a tax allowable expense. And it carries the risk of default if interest and principal amounts or interest and principal payments are not made. So that's on slide number 19. And on slide number 20, we're looking at security, or what we call charges. Whenever you get loan, especially from the bank, you have to offer collateral, or what we call fixed charge. Now, fixed charge, that's when debt is secured against specific assets. The specific assets have to be high-value items or high-value assets that have an active second-hand market, where if you're going to default, the bank can easily go sell your assets. And these assets should not change in value significantly. Examples of fixed charge assets are items like land and buildings. So they have high-value items that do not change in value significantly, and they have an active second-hand market. So in that case, if you offer fixed charge, then the interest rate that the bank will charge is going to be lower because the risk is lower. Then floating charge is anything else that is not fixed charge. So that's when debt is secured against general assets. If you offer floating charge as collateral, then your interest rate is most likely going to be higher than if you offer fixed charge assets. So that's it on slide number 20. We go to slide 21. On slide number 21, we're looking at covenants. Loans come with covenants. On slide number 21, we just have 4 of the most common covenants. We have dividend restriction, where the company will be restricted from paying excessive dividends, or they'll be told you cannot pay dividend that exceeds 50% of your earnings. And we also have covenant that have to do with financial ratios, where the company should not exceed or should not go below certain ratios. An example is, company might be told that they need to maintain their interest cover ratio at above 2, or they should keep their gearing ratio at below 60%. Those are financial ratio covenants. Then on financial reports, the company will be required to maintain audited financial statements. Means it also lowers the risk of creative accounting from the financial statements perspective. Then lastly, we have issue of further debt, where in this case, the bank will not allow you to issue further debt unless if that debt is subordinated to their debt, which means in a case of winding up the company, they have the first charge. So they have the priority to first receive their money before the other debt holders receive their funds. That's it on covenants. Now, what we're going to now do is we want to separate these covenants. Look at the prohibitive covenants and the covenant that requires us to adhere to certain conditions. Well, first we're going to start by looking at negative covenants. Our negative covenants are our prohibitive covenants, which restrict us from undertaking certain activities. Firstly, they say you should not incur any additional long-term finance. You cannot get any more borrowing. The logic behind this is, if a company is going to get more loans, then it means that they have now more pressure on their operating profit. They have to pay more interest. And at some point in the future, they have to pay principal amounts back. Then 2, pay cash dividends exceeding a certain threshold. We talked about this. We're saying the company will be restricted from paying excessive dividends. So an example, the covenant might say you cannot pay dividends that are more than 50% of the earnings. And the company might also be prohibited from selling certain assets. These assets might have been offered as collateral, so they cannot be, so they have to be kept. All these assets are the assets that are generating the cash for the business, so they cannot be sold. And the company may be prohibited to enter into certain types of leases or combine in any way with another firm, compensate or increase salaries of certain employees. So we call this prohibitive covenant. They restrict the company from undertaking certain activities. So this might reduce the flexibility of the directors in a company. So they might not be able now to just maybe go to another bank, get loans because of this prohibitive covenant. Now on slide number 24, looking at forms of debt finance. So debt finance, we have the bank finance, we have money market borrowings. So money market borrowings, the difference with capital markets, on money markets, you get finance for less than 12 months. So you can get finance from a few days to 12 months. That's on money markets. And mostly on money markets, we have interbank lending. And we also have revolving credit facility, where the borrower uses or withdraws money up to a pre-approved limit. When a company is trying to determine the source of finance, they have to consider a lot of things. Like, for example, if they want to use the bank as a source of finance, we said with the bank comes lots of conditions or covenants. So that reduces the flexibility in terms of operational and in terms of execution of strategy from a director's perspective. They cannot just execute a particular strategy because they might be restricted by the finance that they have. And we also have bonds. So a bond is a debt security in which the issuer owes the holder a debt, and depending on the terms of the bond is obliged to pay interest at the coupon rate and or repay the principal at a later date. So a bond basically is just a piece of paper which the issuer of the bond is acknowledging that they have an obligation to make certain interest payments as well as principal payments later on. And lastly, we have commercial paper. Commercial paper is unsecured short-term loans issued by corporations, and the type of corporation that issue commercial paper are high credit rating corporations. So they don't need to secure the commercial paper. Because of their credit rating, they're always in a position to pay their liabilities. So these are typically used for financing accounts receivables and inventory. So commercial paper is mostly for working capital. It's a short-term source of finance. In our bank borrowings, we can classify them as medium-term form of finance. Our bonds can be classified as long-term source of finance. Money market borrowings, we say it's short-term, from a few days to 12 months. So that's it on our slide number 24. Now we're looking at slide number 25, criteria for selecting debt. In our chapter number 5, we looked at the criteria that we need to consider before we look at raising finance. We talked about cost, we talked about the currents of cash flows, the impact on financial statements, duration, liquidity. We talked about a lot of factors. But now here we want to look at the criteria for selecting debt. When it comes to selecting debt, we need to look at liquidity, timescale, which is duration, and cost. We mentioned what we call the matching concept or matching principle in financial management, where long-term assets have to be financed by long-term loans. Short-term assets have to be financed by short-term loans. When it comes to the option of liquidity, if you're going to get finance, and you need to consider that the project that you're going to be doing, is it going to be generating cash for you to be able to meet your interest obligations? So if your project is not going to be generating cash, it might be a wise decision for the company to use equity. Because with equity, the ordinary shareholders, we said, when it comes to paying the dividend, it's at the discretion of the directors. But when it's debt, there's always an obligation to pay the interest payments. So you need to consider the liquidity of whatever activity that you're going to be doing. Are you going to be able to generate cash to meet the obligations? Then our time scale, that's what we were explaining, the matching concept. Long-term assets are financed by long-term loans. Then cost. So the cost of debt can be reduced by offering collateral and also by approaching a different institution. And as a company, we know that whenever we're going to go get loans from the bank, then there are going to be covenants. If we stick to those covenants, it means that we can reduce our cost. But theoretically, if the covenants are not stuck to, or if one of the covenants is broken, then the banker or the bank has a right to ask for their money back. So that's theoretical. Although it does not happen, they can renegotiate the loan or they can charge you a higher interest rate because now your risk has increased. But theoretically, they can even require you to make an immediate payment of whatever you owe them. So that's it on slide number 25. Now we're looking at slide number 26, international debt finance. When we looked at chapter number 4, our hedging, we had a net investment hedge where we said if you're going to start an operation in a foreign country, then what you also need to do is you need to get a loan that is denominated in the same currency as the country that you operate in. That's to hedge against the movement in exchange rates. So international debt finance is used as a hedge item. Then we have Eurobonds. So Eurobonds are issued on international capital markets, but they can be denominated in any major currency. And these Eurobonds may be listed on domestic stock exchange, but then they cannot be traded through the domestic stock exchanges. So that's very important. They might be listed on the domestic stock exchange, but then they cannot be traded through the domestic exchange. And they're usually bearer instruments, and they pay interest semi-annually or biannually. Those are Eurobonds. On your exam, you require to know the characteristics of these Eurobonds. So they're issued on capital markets, and can be denominated in major currencies, may be listed on the domestic stock exchange, but then cannot be traded on the same domestic stock exchange. And they're usually bearer instruments that pay interest semi-annually. So that's international debt finance. Now we go on to the next slide. We're on slide number 27. We're looking at the target debt profile. Well, the question that a company has to answer is, should they borrow at a fixed rate or a floating rate? If a company borrows at a fixed rate, if it happens that the variable rate goes down or the variable rate falls, then the competitors that are using the variable rate will benefit, since now they can access cheaper finance. But then if the company is using a floating rate, and if the floating rate goes up, if the variable rate goes up, then the competitors will benefit if they're using a fixed rate. Now what we're talking about here, we call it interest rate risk. And the second question a company should answer is, should they use short-term or long-term debt? Short-term debt is cheaper compared to long-term debt because of the risk. So long-term debt, there's much that can go wrong in the long term than in the short term. So with short-term or long-term debt, we're looking at the refinancing risk. So yes, you can choose to use the short-term finance, but then there's a risk that you might not get refinanced. So it's a refinancing risk. Then lastly, we have, should you use domestic currency or foreign currency? If you're going to undertake an investment in a different jurisdiction, then your loan should also be denominated in the same currency as the country that you're operating in. We call that a currency risk. So that's it on slide number 27. Now on slide number 28, we're looking at interest rate swap. So normally the counterparty here is the bank. So normally it's arranged by the bank. And we have to understand what we call an offer rate and what we call a bid rate. But then we're going to have an example to understand the offer rate and the bid rate. An offer rate is the rate at which the bank is willing to receive a fixed interest cash flow stream in exchange for paying LIBOR. So with an offer rate, the bank will be paying LIBOR. Then they receive a fixed interest rate. And the bid rate is the rate at which the bank is willing to pay in exchange of LIBOR. So in the bid rate, the bank is the one that is paying a fixed amount. Then they receive it LIBOR. Then how it works is the bank always has to benefit. So we're going to look at two questions that I have to do with interest rate swap to fully understand the concept. So the swap can be a fixed to variable, it can be a variable to fixed. So what we're going to do is we're going to look at two different questions, one fixed to variable and one variable to fixed. And we're going to use test to understanding one to understand the interest rate swaps. Well, the question or the requirement says, what is the difference in spray company's overall net interest paid in the year? So spray company is a 10 million fixed rate borrowing. So spray borrowed $10 million and spray was paying a fixed rate. So that's the actual payment. Spray was paying a fixed rate. Then it is entered into an interest rate swap to swap the interest rate to a floating rate. So since it was paying a fixed, it wants to move from fixed to floating. So the idea of moving from fixed to floating is, if you have a fixed rate, you're not going to benefit if the floating rate reduces. So an example is, if you pay an interest of 10%, then the floating rate goes to 8%. Then you lose out on the benefit here, which is the 2%. So Spray here thought that in the future, what's going to happen is the variable rates are going to fall. So they don't want to be locked up in a fixed rate. So they swapped into a fixed to floating rate. Then the bank has quoted a swap rate of 4.1 for LIBOR, with interest fixing dates on the start date of each year of the swap agreement. Spray Company's fixed interest rate is 4.4. So Spray was paying 4.4 on their 10 million. But now Spray is changing from fixed to variable. So now Spray is going to be paying a variable rate. So our variable rate are coded under LIBOR. So it will be LIBOR, the London Interbank Offer Rate, which is the rate at which the big banks borrow from each other. So here we're told that Spray will be paying LIBOR. Spray is paying LIBOR. Then Spray is receiving fixed. And Spray is receiving 4.1. So we'll just re-explain here. Saying the actual interest that Spray is paying on the loan is 4.4. So they already had borrowed 10 million, they were supposed to pay 4.4, that's a fixed rate. Then Spray is swapped into a variable rate. Assuming that interest rates are going to fall down, then they were going to benefit. So Spray entered into a transaction with the bank, an interest rate swap, where it's going to pay variable, and they pay LIBOR. So the LIBOR varies. Then they're going to receive a fixed amount from the bank. They receive 4.1. So in this instance, they pay 4.4 plus the LIBOR, then minus the 4.1. Mean the payment here is LIBOR plus 0.3 or LIBOR plus 30 basis points. So 1% is equal to 100 basis points. So 0.3% is equal to 30 basis points. Then our LIBOR is always at the day that we enter the transaction. So we told LIBOR on the start date of year 2 of the 3-year swap agreement was 4.25, but this had risen to 4.58 by the year end. So we use the LIBOR at the start date, which is 4.25. Meaning that the interest that Spray is going to pay here is 4.25 plus 0.3. And Spray is going to pay 4.5. 4.55%. So we take 4.55% times the 10 million. Spray will pay 455,000. So after the interest rate swap here, Spray is going to pay 455,000. That's how much Spray is going to pay. But then, according to the actual contract, Spray was only supposed to pay 4.4% of 10 million. So Spray was supposed to pay 440,000. So because of entering into the swap, Spray is actually paying 15,000 more, which means that this hedge was not effective here, or this interest rate swap did not work out in the favor of Spray. Because what Spray thought is the fixed rate here, 4.4, is very high. Spray thought that the LIBOR will fall in the future. So Spray thought of moving from fixed to variable. So they moved from fixed to variable. Then our variable was 4.25. But then the bank only gave Spray 4.1 because it was fixed to variable. So Spray is going to be paying the bank LIBOR. The bank pays Spray a fixed amount of 4.1. The net effect is LIBOR plus 0.3. Then our LIBOR rate is at the beginning of the period. So here we note that Spray actually has an extra cost of 15,000. So the answer there is B for test to understand 1. What we're going to do now is we're going to look at another example. Now we're looking at test to understanding 7. The first question that we looked at, it was looking at a company that had a fixed rate borrowing. It had swapped into a variable rate. Now we're looking at a variable to a fixed to see the difference. It says Brazil company had a 10 million borrowing. So again, he has a 10 million borrowing, on which it currently is paying LIBOR plus 0.55. It's paying LIBOR plus 0.55. So LIBOR plus 55 basis points Then the directors are concerned that the interest rates are going to rise. So here it's a variable rate. So they're paying a variable rate. So they're concerned that the interest rates are going to rise. So they want to lock themselves into a fixed rate. Then the bank has quoted Brussels company a swap rate of 2.86 against LIBOR. So Brussels is going to pay a fixed rate. The fixed rate is 2.86. Then Brussels is going to receive. So our payments are in bracket. Brussels is going to receive LIBOR. So the LIBORs cancel each other, then we remain 2.86 plus 0.55. 2.86 plus 0. The total payment will be 3.41%. Says, what is Brussels company's net payment if it enters into the swap? So the net payment will be 3.41%. So just to recap here, saying Brussels took a loan of 10 million. Brussels was actually paying a variable rate, LIBOR plus 0.55 points. And Brussels thought that the interest rates are going to increase, so they locked themselves into a fixed rate. So they went to the bank, then the bank says, you pay us 2.86, we pay you LIBOR. So they pay 2.86, they receive LIBOR. So LIBOR plus 0.55 plus 2.86 minus this LIBOR, we get 3.41%. That's the net payment if they enter into the swap. I think we should just do maybe one more question again on this interest rate swap. We're looking at test to understand 8. Says Mouse company did 10 million borrowing on which it pays interest of 4.35. So that's a fixed amount. So 10 million paying fixed of 4.35. So here Mouse is moving from a fixed to a variable. The reason why you would move from a fixed to a variable is they're anticipating that the interest rates are going to fall. So they don't want to be locked in a fixed interest rate. They want to pay a variable interest rate. And the company directors predict that the interest rate will fall over the next 12 months, what we've been talking about. So they want to use an interest rate swap to enable them to benefit from this predicted movement. So the actual payment, we'll see how much they're paying and how much are they receiving. The fixed rate is 4.35. Well, they want to make a payment of LIBOR. So they approach a bank. The bank is quoting a swap rate of 4.19 to 4.29 against 12-month LIBOR. Well, if they want to pay LIBOR, then the bank is going to pay them a fixed amount. Now, how you determine here is the bank is always going to benefit. So would the bank pay them 4.19 or would the bank pay them 4.29? So because the bank wants to benefit, or bank always has to benefit, the bank will pay the 4.19. That's how you make the decision between those swap rates quoted, the 4.19 and 4.29. The bank has to benefit, so the bank has to pay 4.19. So here, just to repeat, we're saying this company, Mouse company, entered into a loan, 10 million, they were paying fixed rate. But now they anticipated that the interest rates are going to fall. So they wanted to move from fixed to variable. So the actual payment was 4.35. Payment to the bank is LIBOR. They receive 4.19. So in the end, we have 4.35 negative minus 4.19. So in the end, they pay LIBOR plus 0.16, which is LIBOR plus 16 basis points. And says, what will cause the company's interest payment? What will be Mouse company's interest payment at the end of the year? Assuming that the company uses the swap and the LIBOR has fallen to 3.9. So we don't use the 3.9, we use the LIBOR 4.04. So if LIBOR is 4.04, say 4.04 plus 0.16, so the interest rate is 4.2%. 4.2% of the 10 million is 420,000. So the answer there on test to understand 8 is D. Now on slide number 29, we're looking at advantages and disadvantages of swaps. So we start with advantages. So they help to manage your fixed and floating rate debt profiles without having to change the underlying borrowing. So we looked at different questions where either you can move from fixed to floating So the reason to move from fixed to floating is you're anticipating that interest rates are going to fall. From floating to fixed, you're anticipating interest rates are going to increase. And swaps are also used as hedge against variation of interest rate on floating rate debt, or conversely to protect the fair value of fixed rate debt. When you looked at hedge accounting, so that if a company is hedging against cash flows, they want to move from variable to fixed. If a company is hedging against fair value changes, they move from fixed to variable. And lastly, to obtain cheaper finance as an advantage. And disadvantages are interest rate swap may change in the interest rates may change in the future, so you might not benefit. So we looked at a question where the company was anticipating that interest rates will fall, then they will benefit, but that didn't happen. They didn't get the benefit. And lastly, the creditworthiness of the bank. So although he had stated as a disadvantage, rarely do banks default on their obligations. So that's it on advantages and disadvantages of interest rate swaps. Now on slide number 30, which is cross-currency swaps. Now cross-currency swaps allow a company to swap a currency it currently holds in a different country for a fixed period, and then swap it back at the same rate at the end of the period. What can happen is, if a company is operating in South Africa and they want to have a project in the USA, they can borrow in South Africa because they get competitive rates in South Africa. They borrow 1 million in South Africa. But then they want to undertake a project in the USA, so they have to swap their borrowing with a company that also needs the rand. They get the US dollar, that other company gets the rand. They pay interest on the US dollar, the other company pays the interest on the rand, which is more of our matching concept. Where if you're going to operate in USA, because you're going to generate cash in the US dollar, you also want to pay interest in the US dollar. You want to avoid the movement in exchange rate. And with the swaps, when the currencies are swapped today and when they're swapped back at the end of the period, they are swapped at the same rate, at the same exchange rate. And what we're going to do is we're going to look at an example of our cross-currency swaps. And on cross-currency swap, I'm going to explain using an illustration. Then you can do test your understanding 3, because there's only one question that has to do with cross-currency swaps. So the illustration says ABC company is a US company that has issued 100 million Swiss francs, a euro bond. So it's 100 million Swiss francs. On which it pays interest 6 monthly at an annual fixed rate of 6%. So we talked about euro bonds. So euro bonds, they pay interest biannually. An ABC company has many operations in the USA, so wants to swap its loan of the Swiss francs into a US dollar loan using a fixed cross-currency swap. So here we have a company in the USA. They raised money using a euro bond, so they could be able to raise 100 Swiss francs. Now we said with the euro bond, you can raise money in any international currency, and the euro bond can be traded on the local currency. So Eurobond can be listed on the local currency, but then cannot be traded on that particular currency. And the Eurobonds, they pay interest biannually. So here the company wants to operate in the USA. What the company does, they can approach a bank. Then they go to the bank and say, we want to have a cross-currency swap. We don't want the Swiss francs. Because we have operation in the USA, who would rather pay interest using the US dollar to match our cash flow with the interest payments. So the exchange rate at this particular date was 1:1, 1.1, which is the CHF and the dollar. So conversion is basic proportion. So here the CHF is what we call the base currency, and this dollar is our variable currency. So proportion will always be maintained here. The base currency will always be lower than the variable currency if we're doing any proportion changes. So here, since we have 100 million CHF, 100 million is on the base currency side. We want to determine the number of dollars. So the number of dollars have to be higher, so we multiply with the 1.1. So number of dollars is 100 million, $110 million. So that's at the date of inception. Then our interest is going to be paid biannually. So the interest now paid on this US dollar loan by the company, ABC company. So ABC company will pay interest on the loan. They pay 5.5%. 5%. So they pay biannually. So we take 5.5% times 110 times 6 over 12. And the figure there is given as $3.025 million. So we got the 110 million, we gave the bank 100 million Swiss francs. Then the bank will pay 6%. So the bank pays 3 million CHF. Now, since ABC is the one that took out the euro bond, the bank would then pay 3 million Swiss francs to ABC. And ABC pays over to the holder of the bond. So I'll repeat that. So now how this transaction works is, ABC company got 100 million Swiss francs. But then they didn't want Swiss francs. They converted this, or they entered into a cross-currency swap with the bank. They got 110 million. They gave the bank 100 million. ABC will pay the interest on the dollar denominated amount. They pay interest of 3.025. The bank pays the interest of 3 million CHF. They pay this interest to ABC. ABC is the one that issued this bond. Then ABC will pay over the 3 million to the holder of the bond. So that's what that illustration is. Just look at it. So you can just go through the whole illustration. Then in the end, ABC will swap back this 110 million to get back the 100 million. So at the end, ABC will get the 100 million Swiss francs. The bank will get back the 110. So this is at the same spot rate. Then ABC will take this 100 million, pay it over to the holder of the bond. So that's how a cross-currency swap works. Now on slide number 31, we're looking at advantages and disadvantages of currency swaps. So advantage says it's useful for changing the currency profile of a debt, like how we noticed where a company had had issued a euro bond, but then they could change that to a US dollar. And it may help reduce interest rates and broader strategy of managing currency risk. The disadvantage is default by the third party, which might be the bank. So the counterparty might be the bank. So that's it on our slide number 31. And we go to slide number 32. On slide number 32, we're looking at other sources of finance. So first one there, we have retained earnings. If a company has cash reserves internally, they can use that as a source of finance. And that's the cheapest source of finance. So according to our pecking order theory, if you're looking at financing, first of all, you need to look at, do you have retained earnings? Do you have the cash in the business? Then if you don't have, that's only when you consider other sources of finance. And we have sell and lease back financing, where, for example, if a retailer owns a property, then they want finance. What they can do is they can sell the property to the bank, then lease it back from the bank. So it depends how they're leasing back. Is it a finance lease or operating lease? But what we're concerned with is the substance of the transaction. So in most cases, the substance of the transaction is the retailer is just borrowing money. They're offering their property as security. Then we have grants. Grants, we talked about them. We have capital grants, we have revenue grants. Capital grants are used to stimulate capital assets. So if you have a certain industry that is very capital intensive, the government can come in and try to help in terms of buying capital equipment. Then we have what we call debt with warranties attached. Debt with warranties attached, the different convertible debt is. Debt with warranty attached, you have an option as an investor to convert to ordinary shares. But then this option can be traded separately. So it can be detached from the security and sold separately. Unlike convertible debt, if you have in convertible debt, you have an option to convert to ordinary shares, but then it's not transferable. It's not transferable. Then we have venture capitalists and business angels. The difference between the two is with the venture capitalist, it's a firm, it's a company that has shareholders. And with the business angel, these are individuals, a group of individuals. And the risk appetite of business angels is more, since they are investing their own money. But in a venture capital firm, they're not investing their own money. So they have to at least try to protect the investments. And venture capitalists, they're always required to have a seat on the board. They want to participate in the financial and operating policies of a company. Then business angels might not want to be involved in the board, so they might be silent partners. So they might just want to help you with their expertise and their contacts. Or business angels are those individuals that have made it in a particular industry. And now they are willing to invest in other potential entrepreneurs in the same industry. So what they do is they offer expertise, they also offer their experience to other entrepreneurs. Whilst venture capitalists, these are companies. Those company investors invest money, and venture capitalists mostly, they're looking at financing companies that have a track record or high growth companies. So they're trying to minimize the risk. They don't usually finance startups, but business angels can finance startups. So that's slide number 32. Now on our last slide, we're looking at lease or buy decisions. Our leases were covered in our previous syllabus, the F2 syllabus, but then we're just going to recap them. We have two types of leases, a finance lease and an operating lease. A finance lease transfers substantially all the risk and rewards incidental to ownership, which means that the economic substance of this transaction is you own the asset. So although the legal form is you leasing the asset, but then the economic substance is you own the asset. If you own the asset, then you have to show this asset on your balance sheet and you depreciate it. Then an operating lease is any lease that is not a finance lease. Operating leases are common for office and business equipment, and usually they include maintenance. When we look at finance leases, how we can determine if a lease is a finance lease, there are certain conditions that you can look at. So one of those conditions is, if you're going to use the asset for majority of its useful life, then it might be an indication that the lease is a finance lease. Or if you're using an asset for 9 years when its useful life is 10 years, then there's an indication that the lease is a finance lease. Another indication that a lease is a finance lease is when you have a specialized asset where it cannot be used by any other party without major modifications. So that is an indication that the lease is a finance lease. In our exam, the examiner will indicate if it's a finance lease or it's an operating lease. Now, what we just need to do is we need to make a decision between leasing or buying the machine. If you're buying the machine, the relevant cash flows are your purchase cost and the depreciation expense. Because the depreciation, we get tax depreciation from the tax when we get a tax allowance. So our tax depreciation. So we need to be in a position to calculate the tax allowances. And then on a finance lease, we need to be able to determine the interest rate that we're paying, or the interest that is implicit in this finance lease. So that interest is tax deductible. So we want to understand how much are we paying interest so that we know what is our tax allowance. So our cash flow will be the interest payments as well as the tax allowance. What we're going to do is we're going to use an example to illustrate what we're talking about on slide number 33. So before we look at an example, I just want to explain on leases. So we said with our leases we have finance lease and we have an operating lease. So in a finance lease, the substance is you're actually buying the asset. So you're paying interest, you have interest payments. Those interest payments are going to be tax deductible from the taxman's perspective. So when you consider in the leasing decision, the cash flows that are relevant is your lease payment as well as your tax allowances on the interest. On our leases, we have two ways of calculating the interest on our finance leases. We have the actuarial method and we have the sum of digits method. Now, all those methods help us to establish the interest when it's a finance lease. So we're going to use an illustration in our book's illustration number 3. Illustration number 3 says, assume that KL company has an option to buy an asset for 100,000 or lease it under a finance lease for 29,500 per year in arrears for 4 years. Clearly the interest element, so now they're just explaining, but here we're told that we're making payments of 29,500 on a lease for 4 years. And the value of this asset is 100,000. So when you do leases, you need to come up with an amortization table where you start with the opening balance and you put your effective interest, put your payments, and you have your closing balance. And if we are paying 29,500 a month, for the 4 months we would have paid 18,000. So we pay 118,000 for an asset that has a value of 100,000. Then what this means is, in this lease agreement here, implicit in this lease agreement is there is an interest cost. Implicit in this lease agreement there is an interest cost, because we pay 118,000 when the value is only 100,000. And we're told that the implied interest rate here is 7%. That's the implied interest rate. An implied interest rate, we just say in this lease agreement, although it's not explicitly stated that there is a 7% interest being charged, it's implicit in this contract because we're making a payment of 18,000 more than the fair value. So the 7% will calculated by the actuarial scientist. So we calculate the interest here, we say 7% on this, it's 107, it's 7,000. It's 100 plus 7,000. Then we subtract the payment. We get 77,500. Then you need to do this for the second year. You calculate your interest. Interest now is 5425, and we get 53,250, and it becomes your opening balance 53,250. Again, you calculate 7% is 3,740. Then we have 27,665. Lastly, 27,665. It's 1937. Now balance is 102. So this 102 is because of our rounding off here. Because the balance there should go to 0. So at the end of the 4-year lease, our closing balance will be 0. And what we're saying is, over the 4 years we've paid 18,000 interest. So if it's under finance lease, this interest has to be tax deductible. But then in your exam, the examiner might say, deduct the full payment is tax deductible. Or they can say the interest amount is tax deductible. If they say interest amount is tax deductible, then we get a tax allowance on this amount. That's using the actuarial method. In the actuarial method, we have in advance, we have in arrears. Here we're looking at in arrears, where payments are made at the end of the year. If it was in advance now, payments will be made at the beginning of the year. But for now, let's talk about in arrears. In arrears, payments made at the end of the year. So you have 4 periods that we have interest. The interest we added, it should go to 18,000. Then using the sum of digits. In the sum of digits, we know that here we had 4 years. But since we had 4 years, we had year 1, year 2, year 3, year 4. We just take 4 plus 3 plus 2 plus 1. So equal to 10. Then you put your 4 years. So in year 1, it's 4 over 10 times 18,000. Year 2 is 3 over 10 times 18,000. It's 2 over 10 times 18,000. 1 over 10 times 18,000. And our values here is 7.2, 5.4, 7.2, 5.4, 3.6, and 1.8. Now those will be the interest amounts using the sum of digits. So if the taxman is going to give you allowances, the allowance will be based on those interest amounts. In your exam, you need to be in a position to be able to calculate your interest payments using the actuarial method as well as the sum of digits method. So that's if payments are in arrears. If payments were in advance now, even if we had 4 years here, interest would only be paid for 3 years. So whenever payments are being made in advance, if you're making payments in advance for 5 years, you only pay interest for 4 years. And in this case, you're making payments for 4 years. So the interest will only be in 3 years. Which means that under the sum of digits method, if you're 4 years but you're paying interest in advance, you don't consider the 4th year. You just take 3, 2, 1. Add this, you get to 6. Or you can just use the formula in your book to calculate the sum of digits method, which is n bracket n plus 1 divided by 2. I just prefer this method where if you have 3 years, you just say 1, 2, 3, you add them together. If you have 5 years, you say 1, 2, 3, 4, 5, you add them together, you get 15. So the sum of digits and actuarial method are just there to help us establish the interest rate. That's if the examiner wants you to calculate the tax allowance only on the interest. So saying in our exam, the examiner might say you get your tax allowance on the full payment. So what I want us to do is look at a question that has to do with this interest amount. And now we're going to use a question to illustrate what we've been talking about. So what we're doing here, we're trying to establish the interest that is part of the lease agreement. That interest helps us to calculate the tax relief that a company will get. So here we're discussing our lease or buy. Say, should we lease a machine or should we buy it outright? So on leasing, the relevant cash flows are the lease payment as well as the tax relief. On the buying option, it's your cash payment when you buy the asset as well as your tax depreciation. So we're trying to establish the interest. We said we have two methods, the actuarial method and the sum of digits. So here we're looking at number 88. So using the sum of digits method, what is the tax relief on interest paid in year 3? So we told that company S is considering acquiring an asset which will cost $450 to purchase outright. However, S is exploring leasing the asset. The lessor will charge $120,000 per annum in arrears for 4 years. Now if it's an arrears, so we just say 4, 3, 2, 1. We add them together, we get 10. And year 1 we put 4 over 10. Year 2, 3 over 10. Year 3, 2 over 10. Year 4, 1 over 10. We multiply with the interest rate. Here the question only wants for year number 3. So we say 120 times 4. 120 times 4, that's 480. 120 times 4. That's 480. 480 minus that 450, that's 30,000. So say 2 over 10 times 30,000. This is equal to $6,000. So $6,000 is the interest amount in year 3. So if you're leasing and this is your interest amount, then you're going to get a tax relief only on the interest amount. So although the company is paying $120,000 every year, but we're saying in that $120,000, the component that is interest is only $6,000. So the company will receive a relief of 6,000 times 30%, which is 30% times this, 1.8. Should be 1.8. 0.3 times 6,000. 1.8. Then 1.8 will be the tax relief. Now, had this question said the payments are made in advance, so it was still going to be 120,000 times 4, which you said 480. Interest was still going to be 30,000. But then we would say, since payments are made in advance, in the last year there are no interest payments. So although we have 4 years, in the 4th year there are no interest payments. So now in this case it will be 3 plus 2 plus 1, which is 6. And we say year 1, year 2, only year 3. Then year 3 over 6, 2 over 6, 1 over 6. That's the difference with payments in advance and payments in arrears. If your payment is in advance, if it was 5 years, now assume it's only 4 years, because in the last year there won't be any interest amount, because the payment would have been made at the beginning of the year. So therefore it knocks out the principal amount as well as knocking out the interest. So that's the principle between sum of digits. In arrears, you just take the number of years, add them together, or you apply the formula. In advance, always remember to remove one of the years. So that's it on calculating the interest portion. Now I want us to look at test to understanding 4. It's a lease or buy option. It says penny company wishes to invest in new equipment costing $130,000. The equipment has a life of 4 years and has no scrap value. Tax allowable depreciation is available at 25% on reducing balance basis. The company can borrow at 12% pre-tax. On that note, when we are discounting, whether it's the buy option or the lease option, we discount with the post-tax cost of debt or the cost of borrowing. So we use the post-tax. Always remember we use the post-tax. So you'll be given a pre-tax rate. And the equipment could alternatively be leased for a cost of $40,000 per annum, payable in arrears over 4 years. Assume that the full lease payment is tax deductible expense. Corporate tax is 33%. Let's start with the lease option. So year 1, 2, So 1, 2, 3. 1, 2, 3, 4. So here we told tax is payable 1 year in arrears. So in the lease option, we start with the outflow, which is the payment. So our lease, we're making payments of how much? 40,000 per annum. And our discount rate pre-tax is 12%. So we say 12% times 0.75 to find the post-tax. So our pre-tax is 12%, say 12% times 0.75, which is 9%. Our first payment is 40,000 for 4 years. This is an annuity. So it's a constant payment for 4 years of 40,000. What we can do is we can go to our annuity factors in our tables. We go to present value tables. You find where there are cumulative present value tables. They're also known as annuity factors. You go to 9%, you go to year 4. 9%, you go to year 4. Then you find the annuity factor, you multiply with the 40,000. Or what you can do is you can individually discount the 40,000. You find the discount factor for 9% in year 1, year 2, year 3, year 4. And in this question we're told that assume the full lease payment is tax deductible. So before we came to this concept, what we're trying to do using the sum of digits actuarial method is trying to figure out how much interest is already included in the payment of the 40,000. So here, since the machine was 130,000, then we would first multiply 40 times 4, which is 160,000. Then we say 160,000 minus 130,000. We note that there's a 30,000 interest payment. Then using the actuarial method and the sum of digits method, we're trying to allocate the interest because the interest was the one that was tax deductible. But now in this question they say the full payment is tax deductible. So we take 40,000 times 0.33. Means our tax allowance at 13,200. But then since it's an arrears, it starts off in year 2. And here what we can also do is, this 13,200 starting from year 2 to year 5 is also an annuity. We can go to our annuity tables. But now on our annuity table, we'll find the annuity factor in year 5. Subtract with the annuity factor in year 1. The reason we're doing that, annuity factors are cumulative discount factors. So from year 1 to year 4, they take the discount factors. So an example, if it's 10%, this is 0.909, 0.826, 0.751. We add them together. They become an annuity factor. Then we just multiply with 40,000. Since 40,000 is the common factor. And here, since the payment is only starting in year 2, we also use annuity factors, but then we use them differently. Because the annuity factor that we're looking for is discount factor for year 2, 3, 4, 5 combined. That will be the annuity factor. But how we can do that, we can go to annuity factor in year 5 minus annuity factor in year 1. Then we get our annuity factor, we just multiply with 13.2. Or just for now, find the discount factor. So I'm going to use my calculator. Yeah, since it's 9%, we say 1 divided by 1.09. So this is 0.917. Then 1 divided by 1.09 to the power of 2, 0.842. 1 divided by 1.09 to the power of 3, 0.772. 1 divided by 1.09 to the power of 4, 0.708. 1 divided by 1.09 to the power of 5, 0.650. So this will be our discount factors. So you multiply 40,000 with this, you multiply the total year, multiply the total, multiply with the total. But in your exam, then you don't have the time to do this. So what we're going to do is we're going to have a separate video that explains how do you deal with annuities, how do you deal with perpetuities. So you can pause this video, you can stop the video, then go look for the video that has to do with annuities and perpetuities. It will help you in terms of doing this in the exam. So I'll be explaining the concept on how do we apply the annuities and how do you apply the perpetuities. But in this case, you can just go continue from this to see how do we, or what is the present value on the lease option. Then on the buy option, the relevant cash flows is in the first year, not in the first, in year 0, we have to buy the asset outright. So there will be a cash flow of 130,000. Then we're told that the tax depreciation is allowable at 25% on a reducing balance method. So we'll take the cost asset, which is 130,000. Then we start applying the reducing balance method. We say 25% times 130,000, 32,500 minus 130,000. Which is 97,500. So times 25%, okay, 24,375. Get 73,125 times 25%, get 18,281.25 minus 73,125. 73,125. 54,843.75. So here, did we have any scrap value? So the no scrap value. So in the last year, we need to find the balancing figure. So this is depreciation for year 1, depreciation for year 2, depreciation for year 3. In the last year, we need to put the 54,843.75 so that we get to 0. That will be the 4th year depreciation. But then this is just a depreciation. To get our tax allowance, we'll be multiplying with the tax rate. So what I want you to do is just want you to take those amounts, multiply with the tax rate, then you come insert them from year 2, 3, 4, 5. Then you put your 9% discount factor, apply the relevant discount rate. So you can also check your answers at the back of your book. But the concept is, with lease or buy decision, under the lease, the relevant cash flows is the lease payment and the tax relief. The tax relief can be on the interest amount. If it's on the interest amount, we can calculate our interest amount based on the actuarial method or the sum of digits method. Or they can say the full payment is tax deductible, like the question that we just did now. Then on the buy option, the relevant cash flow is the amount that we bought the asset for and the tax depreciation. So that's it on our chapter number 6, our debt financing.